I'm Dylan Marma, and you're listening to Operators and Allocators, a podcast dedicated to exploring how to make smart investment decisions and execute well in real estate and private equity. We'll be interviewing top-notch sponsors from various asset classes to understand how they think and the frameworks that they put in place with the goal of achieving above-average risk-adjusted returns. Welcome back to another episode of Operators and Allocators. This is your host, Dylan Marma, and today we are joined by a great guest. We are going to be joined by Mr. Todd Sulzinger. How's it going, Todd?
Oh, it's going great. How are you doing today, Dylan?
I'm doing really good. Well, thanks for jumping on the show here and spending some time with us. So first off, I'll give the listeners a quick background. Todd is the CEO of Blue Elm Investments, a private equity real estate firm based in San Francisco. He is a former Silicon Valley corporate finance executive that has turned into a real estate investor, and he's lately had a heavy focus on mobile home parks. Blue Elm focuses on stabilizing neglected, underperforming mobile home parks and other asset types to be able to create strong risk-adjusted return for their investors. And Todd is also the co-author of Success Habits of Super Achievers, a #1 Amazon bestseller. So Todd, we got a lot to learn from you. Definitely glad to have you on the show.
It's great to be here.
So why don't you start off and share with us how you got your start?
Sure. As you mentioned from that intro, I spent most of my career working in corporate finance for a variety of technology companies here in Silicon Valley. And I actually had met a neighbor that I was a couple doors down from me when I was still working full time. And he was just this mild-mannered guy, drove a beat-up car, didn't really dress well. But every time I talked to him, he would mention something about, oh, this house I own down the street, or, oh, this shopping center I own, across the hill over in Santa Cruz. And I just kind of realized this was this example of a millionaire next door, and just got to know him a little bit better and talk to him about his path, and decided I wanted to see if there was some way I could, start to invest in real estate, and eventually wanted to turn that into a business. So I just started off buying some single family homes in the Dallas-Fort Worth market back in 2013, and took the big leap at that time, deciding to invest thousands of miles from where I live, which took was a big mental hurdle to get over, to realize that you could actually invest somewhere not in your backyard if you have the right property managers and could find the right properties and knew the market well. So I kind of got started doing single family homes with the idea of buying multiple homes over time and be able to replace my W-2. Over time, I realized that it was going to take a lot of those houses over a long period of time to get to that point. So I started to educate myself about real estate syndications, where you can have group investments, bringing together people who are interested in investing in real estate, but don't want to deal with all the headaches around managing properties and doing all that research. So in 2019, I ended up buying my first mobile home parks in a syndication that I put together.
Mm-hmm. Fantastic. Well, I definitely appreciate that. And I see a lot of crossovers in our story. I think a lot of people probably share somewhat similar stories as they going to sponsoring, right? Unless you maybe went to school for real estate and go out and get on that path extremely early. I think a lot of people end up going the route of taking a W-2 job and sort of stumbling into real estate at some point, and starting off with the traditional route of purchasing single families. It sounds like you use a third-party management company. I did the same thing, and I remember having the same sort of wake-up call where I said, hey, this is a solid path, and it's almost a sure thing path, but I don't know if I want to be in the same job for the next 10 years, buying 2 houses a year. And I didn't resonate with that vision for my future. And I think for me, I think it was partially the income potential through the real estate model, but also I just think something drew me to it, almost the excitement and the I always say the intellectual stimulation that comes from taking on something as big, almost a big goal that where there's going to be a lot of big learning curve to be able to build something like this. So what was it for you that was sort of the real draw to go and pursue syndication rather than stick on that buying single families every year path?
Some of it was just over time, I kind of felt more of a lack of control in my W-2 job. I had a great career. I got to travel a lot. I lived in Europe for a couple of years, worked with a lot of great people, but also got to that point in multiple situations where I didn't have control of my job. When you work in the startup environment, oftentimes companies will get acquired and they don't need two finance departments. Or I had been in situations where I was working for a really great company and they said, okay, we're relocating the entire finance group 500 miles from where you live. So just kind of always knowing that there could be potential future opportunities, especially in Silicon Valley where there's a lot of great companies and opportunities, but also just knowing that at any point in time, a company might get acquired, there might be layoffs, all kinds of things can happen in that environment. And I thought in real estate, I had a passion and an interest in real estate and thought I could combine my finance background in terms of analyzing deals to create this business. I didn't really think that I had the entrepreneurial bent in me just because I'd spent so much time working in a corporate environment. But once I started to move into that, I just found it to be just really interesting to work on deals, to research properties, to go out and visit them, put deals together, while at the same time helping people that I had worked with for years who had an interest in investing in real estate, but just had no idea how to do it. And this idea that they could go in together and buy a mobile home park or buy an apartment together in a group investment just, really blew people away. So that was kind of exciting to bring people that I'd known for a long time along the journey to invest passively in real estate deals.
Yeah. Well, what's fascinating is that you're coming from the startup world, right, and the technology world, and then jumping into being they call it a dirt investor, right? A lot of the times people are on one side or the other. They're either chasing the growth in the tech space, or they're chasing the sort of security and consistent cash flow that I think real estate can provide to you. So what do you think drew you to real estate? Why were you also investing in technology companies? Did you do any VC investing, either private, or you invest in the stock market, or you've always just been drawn to something more about real estate?
Well, from the time that I started working, I just kind of did that traditional path of putting money in a 401k and trying to maximize the company match. And it wasn't until other than investing in some real estate funds within a basket of mutual funds, I hadn't done any real estate investing at all. There was one point in time for a couple of years when I had moved to another house in relation to a job transfer, kept my house and rented that one out. Probably learned during that time frame that I didn't really want to be an active landlord, and that hiring property managers to take care of properties is a better way to go for me. And then it really was just like really taking the plunge after listening to podcasts, reading books about real estate investing, what it can do, as when I first bought those single family homes in Texas, and just felt like, the more stories I read about people who had really built long-term wealth, with that stability of long-term cash flow and being able to take advantage of appreciation and be able to leverage your investments, it was really critical. I mean, I remember that, one of the first times somebody said, if you wanted to buy $100,000 in stock, could you go to a bank and ask them, would they, could you only put down 20%, let the bank lend you 80% to buy the stock? And it's like, there's no way they would do that because there's too much volatility and there's not any true value there. Whereas in real estate, that happens all the time.
Yeah. No, those are all really, really good points. And I think that's what it comes back to, is that one of the greatest things about real estate is that it may not be it's definitely not the fastest way to create wealth. Right. You hear these stories all the time of these, tech entrepreneurs, things along those lines that can blow up overnight nearly. Whereas real estate is much more of a slow and steady path, but it's one of the most sure ways to compound wealth over time. Right. It's a vehicle that if you're disciplined and you stick to the right fundamentals long term, you should end up in a good comfortable spot, I think, right? So that I can definitely resonate with that. So moving forward, you got into some single family, then you went out to get your first syndication going in 2019. Then you've been growing in the mobile home park space. So talk about what you see in today's market. What's got you jazzed up? Where do you think the most opportunity is in today's market? Are you still pushing hard in the mobile home park space? I know you also mentioned considering some other asset types. So maybe share with us, where do you think the opportunity is today in 2022?
Sure. Well, I'm still actively looking at mobile home parks. I actually closed on one in just in a JV partnership with one other person for a park in Arkansas last year.
Great.
And sometimes one of the things I found with mobile home parks from a syndication standpoint is sometimes doing the full turnaround deal in a syndication can be challenging, just because you got all that initial investment up front. You might not have cash flow coming in for a year plus, and so to find the right investor mix looking for that, I think, can be challenging. Which is why in this most recent deal, it made more sense, because it's a turnaround park to have gone in with in a joint venture situation. So there's still opportunities out there. There's just as you know, over the last 5 years, there's a lot more people in this business, whether it's kind of newer syndicators like me, or bigger operators. You got publicly traded companies, other large operators who might own 10, 20, 30 plus parks. So a lot more competition out there, but still less than multifamily. And that was one of the things that got me interested in it in the beginning, which I think is still the case now, is when I would talk to some of my multifamily operators, they would be going into deals where there'd be 10 different offers, and they'd have to put $50,000 or $100,000 hard money, non-refundable, right away. Whereas in the mobile home park business, if you can find the right deal, potentially with seller financing, I've gotten into the park that I bought in Arkansas last year. I told the sellers, 84-year-old husband and wife who were selling the park, and said, "Oh, I should probably put $5,000 or $10,000 into an earnest money deposit, just to show we're serious and get escrow opened." And the guy just said, "You don't really need to do that if you don't want to." So he was absolutely
That's
fine
great.
just with just a single piece of paper saying, here's the purchase agreement, and open escrow, and go through the process. So I still think there's definitely opportunities there. I am looking, just from a diversification standpoint, for my investor group, to look into potentially partnering with some larger multifamily operators. I still think there's just great opportunities, whether it's mobile home parks or apartments, in terms of where inflation's headed now, and
Big time.
interest rates are starting to creep up, but there's still this ability to get really good financing and take advantage of the long-term growth with what's going to happen, just and what naturally happens with inflation, where the rents will increase over time as inflation happens, and wage growth happens there. So I'm still looking at mobile home parks, and then also, again, looking at some of the working with some bigger operators in some larger markets from an apartment standpoint.
Love that. Yeah. So I know before the call, you and I were chatting about just the headaches that take place on the mobile home park operation side. And we were talking about how it seems like there's very, very few quality third-party managers. I'm not going to say none, because I haven't really put myself out there to interview many, but the consensus seems to be that for those that really want to grow the platform, and often ends up being something that you're required to roll up your sleeves and go out there and get active. And even if you're using a third party, there are some quality third parties out there, but you probably still have to spend a lot of time managing the manager, right? And sort of partnering with them, which is true for almost any asset type. But I feel that mobile home parks specifically end up being more time intensive. So maybe speak to that. What were some of the bigger surprises or headaches that you've dealt with on the operation side in the MH space?
Well, I would say, thinking about the first parks that I bought in Georgia, right now, I think we're on our fourth or fifth manager. And I think this husband-wife team that we have right now is the best we've had since we've owned the park.
Great.
But that's been the trickiest part, is you'll get somebody who might seem like they're good, say the right things, and then it turns out they're not that great, or they might work really well for 6 months, and then something in their life goes sideways, um, and they start not managing the park well. We had a situation where we had a person who was the on-site manager, living in the park, decided that she wanted to live outside the park because she was going to live with her mom, had a baby. We thought she was still living close to the park. And then about, I don't know, 6 months into it, we found she was living an hour away and was only really coming to the park a couple times a week. And, we didn't know that. We were having regular calls with her, and it seemed
Jeez.
like she was on top of things. And then just, through multiple conversations, I found out that she was like not living close to the park. And, you need somebody, if somebody's, not living in the park, they have to be close enough to be able to go there often. So I think just, finding, training, and then keeping good managers or good maintenance people is could be really difficult. And when you find one that's good, you really got to hold on to them and keep them happy and hope they stay for the long term.
That's crazy. It reminds me, our management story of the week is that we recently had someone that came on board and started up with us. And then within the first, I want to say it was 1 or 2 weeks of them being on board, they went out and hired 2 additional people without even running it by us. And we found out you hired someone, right? You hired a maintenance guy and a support staff, right? Like, I guess they assume that now they're king of the hill as soon as they're onboarded and have full reins on just where the checks go. So that was yeah, but I definitely can relate to that, right? These things you just never you can't see them coming a lot of times,
Right. And
right?
it's great that you found somebody with some initiative, right? That really
I
wanted to take
appreciated that.
charge, but
Yeah.
a little bit too much.
Yeah, exactly. And who knows where who knows if these were just friends of his or if they're really workers, right? So, so yeah, I definitely get that. And yeah, I think, well, I guess that brings up a good topic though, right? Is in the mobile home community world, a lot of the standard industry practices are paying someone, $10 a site per month or something like
Mhm.
that, right? So you have like a 60 spot park that's it's $600 a month. That's $7,200 a year. I mean, what are you really going to get for $7,200 a year, right? Like, I guess, how high can your expectations be on that? So what is your philosophy when it comes to how do you get the right help? Do you pay more than what the rest of the market offers? Do you check in on them? Do you just go after larger places that can afford better staff? Like what do you think is the right solution to work around there?
Yeah, I mean, and some of it does depend on the type of park that it is. Like the parks that we have in Georgia, it's primarily park-owned homes, so we definitely need a strong maintenance
Mhm.
person. So in that situation, we're willing to pay more for somebody who could do maintenance and management. That's kind of the situation with this current husband and wife team we have in the park, where we're going to allow them to live in a house for free, and also kind of pay maybe above market or more than $10 per pad, because they're going to be pretty active, either doing kind of light rehab to get houses ready, or because you have a little bit higher turnover in a park owned home park, then that person's going to also be doing the park maintenance as well as the rent ready. So if you can find a situation where you really have like a good, I think that's kind of ideal if you have a good husband and wife team where they're
Yep.
fine living in a park, don't have any housing cost, make a little bit of money doing the maintenance, have kind of more flexibility in their day-to-day life versus working at a retail job somewhere, then that's really ideal.
Yeah. No, I definitely agree with that. And we do a ton of park owned homes. I think we own 500 something homes right now. So I can definitely resonate with that. It's much more similar to running a traditional multifamily building, right?
Mhm.
You're going to have way higher payroll costs. And in general, we lean on the high side. Our payroll is probably much higher than a lot of other operators, but we also believe that that's why we can keep running good numbers and keep occupancy where it needs to be and keep eyes on deck, right? It just generally is our philosophy has always been focus on top line growth, right? And spend what it takes to, make this the most quality community that you can in those, and especially in those early years as you're going through sort of the transformation stage. So you mentioned it's getting more competitive. Do you where's your take? What's your take on just where cap rates sit in the MHC space? Are you able to make sense of a lot of the deals on the market? Do you feel like all the deals these days are going to be off market? What do you think is really the best strategy to find quality deals today?
Well, I think it still seems like the best way to really make good money is to find parks that they're going to be in a value add situation, which means when you buy the
Totally.
park, it's not going to be maximized, where it's not going to be a 100 space park that's 90% occupied and running at an 8 cap. You're going to find a park that might be 60 to 70% occupied, that might be, you might buy it at a 3 or 4 or 5 cap, but with the
Yep.
additional few $100,000 investment, either rehabbing homes, filling vacant lots, whatever it might be, then you can kind of get it up into the 10, 11 for 12% cap rate with the right investment. So I think that's really where the opportunities lie, is when you kind of make your own cap rate, versus a lot of people on the consulting side of my business that I do some mobile home park consulting. You often get those calls where people say, oh, I'm looking for 50 plus space park, city utilities, all tenant owned homes. I'm hoping to look for something like an 8 or 9 cap. And it's like, well, maybe in 2010 you could have found that, but those opportunities just aren't out there. So the best opportunities are where you can really go in and make the investment to add value.
Yeah, I couldn't agree more with that. That's what I say all the time, is I want to go and buy the 3 or 4 caps that we can bring to 10 caps, right? Because I know that, number one, the fact that you're walking in at a 3 or 4 cap scares away half the market right away, right? That's
Right.
going to be the barrier to entry. They're going to be scared off. And then, for people that understand the market they're investing into, we can lean into that, saying we feel very confident. We're going to buy it at the 3, bring it to a 10 over that, 2-3 year period, right? It all depends on what the strategy is. Sometimes it might be a longer period if it's just like a simple rent increase, but if it's infill or park owned home sell off or something like that, then you can get there pretty quickly, right? So I think that I would emphasize that for anyone that's actively seeking deals in today's market. I think the broker deals that I see, I can't make sense of the stabilized product because it's just not our business model. But the value add product is the stuff that we go after. I always say there needs to be some kind of a story, some kind of some kind of hair on the thing that's going to get it to outperform for us by giving us that nice 5-year projection, 10-year projection, because we can, we're happy to roll up our sleeves and do the hard work. But we just can't sit back and just buy a stabilized deal that projects 5% per year, something like that.
Right. And that's what I think when I talk to new mobile home park potential buyers, that they just can't understand, like, how could a park only be 50% occupied or 60% occupied? There must be something wrong with the park. But in so many cases, you might have, again, an older operator that has owned the park for a long time, and as a syndicator putting a deal together, you could say, yeah, if you put $500,000 into this park, it can be a home run. But if you're in your 80s, you're not thinking to yourself, oh, let me go out and take more bank debt on at this point in life, or go out and like raise money to really stabilize a park. For them, it's fine. So over time, occupancy might have trimmed down to 50-60%. It's fine for them, but that's definitely is a hurdle when I talk to potential buyers. When if they see low occupancy, they immediately assume that there must be some problem in the market where the lots can't be sold or rented out.
That was my problem too. I had the same thing, right? Because I came from the apartment background, where if I saw an apartment that's 40% vacant, there's something wrong. We're in a really bad market. There's something going on, right? Because most apartments have third-party operators and third-party managers, right, that are available in the area, and they'll come in and they'll lease these things up to keep them 90% plus, generally speaking, right? Obviously, if they're slower mom and pop landlord, maybe they drop down to 80% occupancy. But it's very rare you see something 60% occupied. So when I used to see that in the MH space at first, it freaked me out, right? And I think that same impression probably gets shared by many people that are new to the industry, because you just scratch your head and say, well, there must be something wrong with this area, because if they couldn't do it, how am I going to do it, right? So I think that's where, number one, you have to really rely on knowing your market. I definitely feel like that's the biggest risk to MH. operators is that they go out and chase too many different markets, and then they don't really know their market. So you can't have that kind of confidence. But when you really know your market, you can have the confidence that you know what the comps are, you know how their occupancy is, you know where the rates are, and you can lean into these heavier lift project types. And then two, it comes down to just, I think, just having confidence in your execution and your operations, and understanding, who the seller is, right? I always try to ask myself is, if we do, 80% of our best effort, are we still going to do better than this current seller is, right? Like, is it going to require us to be absolute superstars to keep up with the performance of the current seller, or can we give like an 80% effort and still do better than them, right? Just so we kind of have that confidence. So any signs, anything to speak to in that regards?
Well, I think just kind of getting back to that occupancy and kind of market perspective, I think that's something definitely we look at, and I think one thing we found is that also can scare some people who may have been used to investing in apartment buildings in bigger markets, is that we find that even in smaller markets, there's still demand for affordable housing. So I know some people say, "Oh my gosh, there's only 50,000 people living there. How could this park stay occupied?" But again, you've got a lot of people that might be on fixed income that need affordable housing, or there's enough economic drivers that it's not a Dallas or a Phoenix, but there's still other companies that are keeping people employed in markets that in this environment, people still need an affordable place to live. So I think from a market standpoint, it can't be too far out in the boonies, like way away from things where there aren't those economic drivers. But I think you can find in secondary and tertiary markets good opportunities.
What do you look for in the market? Do you run test ads, or how do you sort of test the strength as you're evaluating a market?
Yeah, that's one of the things we do. We'll run Craigslist ads and just put out there 2-bedroom or 3-bedroom mobile home for rent for $500 or $600 and see what kind of activity we get. And that's usually a really good sign. And then if you don't get any activity, you can drop the price a little bit and see if the activity changes. And if that still doesn't bring in a lot of calls, then it might be an issue in the market. But if you put those ads out there and you get a lot of people calling looking for a place to live, that's usually a really good sign. And then outside of that, even in smaller markets like the parks that I bought in Georgia, it's in a town called Milledgeville, which most people probably haven't heard of. It's about an hour and a half outside of Atlanta. But during my due diligence, I went there and found there were a couple of manufacturing plants, some helicopter manufacturing. There was a carpet manufacturer. There were 3 colleges, a Lowe's, a Walmart. So even though it was a 50, 60,000 population town, there was still a lot going on, which gave us comfort that if as tenants come and go, there'd be a continued demand for that type of housing.
Yeah, love that. Yeah, it really comes down to getting granular and really digging in yourself. I think that you can miss a lot of opportunities if you're not, digging in like that. So, what is one belief that you have that you find to be an unpopular opinion that you hold?
Probably that you can make money with park-owned home-based parks. I think many people, when they get into mobile home park space, they go to Frank and Dave's boot camp, and they are 100% on. You'll never want to own the houses. You only want to rent the lots and have the tenants own their houses. And that model has its benefits for sure in terms of financeability and lower maintenance and lower turnover. But there is another way to make money in the business with park-owned homes. And like you had mentioned before, that's similar to having an apartment or a group of single-family homes. It's very similar to that. So I always think just because mobile home parks has a potential way to run a business where you just own the dirt and rent out the lot and the tenants own the homes, just because exists doesn't mean that's the only way to run a business.
Yeah. And just because you've seen extremely successful operators do it one way doesn't mean you can't also be extremely successful doing it a different way, right? So I think it's an abundance sort of mentality around the ways that you can succeed. And I definitely would agree with that with the park-owned home model. I mean, we've loved it. I've always said to, if anyone sees a deal with too many park-owned homes, be sure to send it our way, just because with today's market, that is one of the forms of hair that we look for, right? It's something that a lot of people don't want to deal with the headaches of. So that's a headache we're willing to put ourselves through, because we know that at the right price point, obviously, it's, there's a lot of opportunity on the other side.
And some of it is market based. Like here in Silicon Valley, I would say most of the parks, probably in a 20, 30 mile radius from where I live, have primarily tenant-owned homes, if not
Yep.
mostly 100%. Because housing costs are so high, so people can spend, 300,000 on a mobile home and pay 1,500 a month lot rent, which again sounds crazy for a lot of parts of the country, but compared to $1 million houses, that's a great deal. You've got other markets where you might think, why don't people put $2,000 or $3,000 down and buy a $20,000 mobile home? And a lot of people just don't want to be homeowners because they have to deal with all those maintenance issues, like if their roof starts to leak or they have to replace appliances or whatever it might be, and they're kind of in that renter mindset. So kind of also depending on market, you might find that it just makes more sense that even if you wanted to kind of turn a park-owned home park into tenant-owned, the market might not support that.
Yeah. It's really knowing your market, because as a whole, we generally do like to sell them off. But in some markets, we're more in a rush and we have more demand to be able to sell them off faster than others. We're sort of not, we never like to fire sale them off, because we think if you sell them for too cheap or give them away for free, people are going to value it for just that, right? And you're going to get kind of a rough resident base in doing so. So we like to sell them at fair market value, and some markets that gets absorbed really well, others it doesn't. The biggest difference that I found, and you've probably experienced the same thing plenty of times, has been the actual the turns on mobile homes versus apartments are a bit different because of the subfloor work mainly. Right? What are damage and subfloor work are your best friends with mobile homes, meaning they're never ending. Right? So a lot of times you're replacing the subfloor with more solid plywood like you would use in a traditional apartment. If you're going to run it as a long-term rental, you need to make sure you get rid of any of the delicate materials that a lot of these things are built with, and start to give it the bones that it needs to be a sustainable long-term place where you're just repairing the carpet and painting the walls, usually on turns, rather than digging up the floors and dealing with some of those issues.
Yeah. Water damage is the killer for sure. Whether it's through the roof or through the walls or windows, that can be the worst part.
Absolutely. So completely agree with that. So we all learn from our own mistakes as well as from the mistakes of others. Share with us one mistake that you've made that would be worth sharing to help someone else avoid it.
Well, let me see. I think one I can think of is when I bought a park in Tennessee. It was a big turnaround park, and when we came in, the city said, "Oh, we're so excited you're here. You're going to be able to turn this park around. It's been a mess for years. You're going to put some money in here. That's great." We met with the mayor, talked to a few people in the city, and then after we bought the park, as we started to do the rehab, then they weren't so friendly. Because in my mind, I said we were going to rehab a lot of the vacant park-owned homes and rent them out, and I think they were in okay shape and could be rented to be made really nice. In their mind, they were thinking we were going to come in, scrape everything, and probably, I imagine they were envisioning they were going to put in all new tiny homes, make this beautiful property. So that I think kind of the lesson I learned from there was to before you buy a park, especially in a big turnaround situation, is to really talk to the city, talk to the actual building inspector who you're going to be working with, to say, like, here is our plan. Are you guys on board with this? Just because
Totally.
what our vision for the park was different than theirs, and that I think would be a lesson, would be to talk more to the city. And I think also to be careful of locations. One of the things we liked about this park was it was right on a byway, so very visible. We thought, oh, that's great from a visibility standpoint for attracting tenants. The downside it was also very visible to the city. So I know I've seen other parks that are kind of in town but down a country lane, and I think, okay, now that park would actually be better because it's going to attract less attention and probably get less attention from the city if you're going to be doing any kind of rehab to turn around the park, versus something that's in a prime location.
Man, that's great. Great advice for everyone. Just because it wasn't until I got into the MHRV when I was just doing apartments, I feel like I didn't really deal too much with planning and zoning. Right, it was a phone call we made to kind of check the box in our diligence.
Mhm.
Whereas with these things, we've brought so many headaches along the way, right, and so many learning lessons along the way working through planning and zoning. And it's so important that you call early on, right, as soon as you see a deal's going through, as soon as you're under contract, call planning and zoning, see what their vision is for, the type of deal you're purchasing, see what their vision is for the long term of it, right? Make sure you're legal conforming, or if you're legal non-conforming, make sure you understand the repercussions of that, right? So I think that's
Also being
important.
careful in a small town. I think when we first went into this deal, it was like, oh, that's great. We know we're actually talking to the mayor. We have a great contact. But then the downside was like, oh, can we get help from the electricity company? Oh no, that guy's the cousin of the mayor, and the building inspector works for so and so, and then the maintenance guy is related to this other guy. So it was this really tight knit community, which we thought was good, but there were certain cases where, because it was such an insular community, that it made it difficult to get things done.
Yeah. Yeah, it's a double-edged sword, right? Because if you're in with them, you probably are really in with them. But if you're an outsider and it's
Right.
you're having trouble kind of breaking through and getting the rapport with the local community, I think that can really that can sting, right? So
Right.
all right, awesome. Well, give us two best practices. One best practice for active operators that are targeting their first or second deal, and then one best practice for passive investors that are looking to invest into mobile home parks or multifamily.
Well, I think from an active investor standpoint, my advice for people that are getting into this business for the first time is to actually take action. I think that's one of the things when I first went to my first syndication seminar back in 2015, and then because I was working my W-2 and it was kind of comfortable, I didn't do anything about it. And then I went back to the same seminar in 2018, and I'm like, okay, I'm going to do this. So I think it's easy to kind of, for people to get started, think they're going to get into it, and then come up against a few roadblocks. So I would just encourage people to keep moving, believe you can do it. You'll be able to find investors, you'll be able to find deals, just keep moving forward, building your reputation, building your network, and move forward and take action.
Love that. I totally agree. How about for LPs?
I think for LPs, do a lot of research, talk to a lot of different people, and then really get to know the operators themselves. I think if you had two equal properties, then somebody that's a good operator, that communicates well, that has some track record, that has a good background, that person's going to always perform better than somebody who doesn't have the experience that's necessary. So I think the property itself is critical for sure, but I would focus more on the experience and trustworthiness of the operator.
Yep, totally agree. And where can listeners find you online? Are you still offering consulting? Is there a way that they can reach out for help in that regards? And how can they plug in to stay up to date with everything you're working on?
Sure. I've kind of got two sides of my business. My main company is Blue Elm Investments, and that's where I put together syndications for passive investors. The other side of my business, I'm working for a mobile home park consulting company called CCI Investments. And in that capacity, I help people that are looking to buy parks, help them with due diligence, create a turnaround plan, do management for those parks afterwards, and just kind of offer any kind of guidance and advice that they need from the mobile home park standpoint. So my website is www.blueelminvestments.com, and they can reach me there, or Todd, Todd, at blueelminvestments.com.
Okay, fantastic. And we'll throw that in the show notes. So Todd, thanks so much for jumping on the show here. It was really a pleasure to get to spend some time with you, and hope to keep in touch.
Yeah, great. Thanks. I had a good time. Thanks, Dylan.
Thanks for tuning in and joining us on another episode of Operators and Allocators, hosted by the Requity Group, a vertically integrated private equity real estate company. You can find recordings of all shows along with other resources on our company website, therequitygroup.com, also listed in the show notes. A brief disclaimer to our listeners. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. All investments are subject to risk and past performance is no guarantee of future results. The views and opinions expressed by the Equity Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions. We hope to see you next week.